I do not have to tell you that we are living through one of the most geopolitically unstable and policy uncertain and macro fragile environments of the last 15 years. And yet, market volatility remains eerily subdued. That contradiction is not benign. It's not comforting, right? It is absolutely not normal. This doesn't make any sense. What you're looking at right there is, on this chart, is a disconnect that defines modern markets for now. On the one hand, policy uncertainty is rising, driven by geopolitics, elections coming up, wars going on, fiscal stress always there, monetary regime shifts. We're going to get a new Fed chair and the court is already polluted, and structural inflation, meaning that we're not going to get down to 0% ever again. So on the other hand, the VIX, which the market calls the fear gauge, remains historically contained. That gap is a story, and that gap is the risk. Today, let's take a look at this chart and explain why markets priced for perfection tend to break violently, not gradually. And that is what we're looking for here, folks. This is what this channel is about. We are looking for black swan. We're looking for signs somewhere. So first of all, how to read this chart. This chart plots two different indicators over time, starting around 2010 and extended to the present. The black line represents the U.S. Policy Uncertainty Index. The U.S. Policy Uncertainty Index. And the red line represents the VIX volatility. And basically the VIX is, not to get into the weeds here, but it uses options on the S&P to gauge what people are doing, what investors are doing. Are they bullish or are they bearish? They are measured on different axes, which is critical. The left-hand scale is the Policy Uncertainty Index, and the right scale is the VIX percentage. So these two series do not move one for one, and they are not supposed to. Historically, large spikes in policy uncertainty eventually force volatility higher. As you could see, during so basically what we're saying is that the policy uncertainty index, the left-hand scale, right, drives the spikes and eventually forces volatility higher. So first we have the fear, which is the black line, and then we have the volatility. Except that, as you could see, and I guess the key is these two series do not move one for one, but historically, large spikes in policy uncertainty eventually forces the volatility higher. Basically, the black line drives the red line. But the key word is eventually, because markets can suppress volatility for long stretches until they can't, and then boom. That's what we're waiting. This is what we're waiting for. We're waiting for that spike. It's going to come. So what does this policy uncertainty index actually measure? Well, the U.S. policy uncertainty index is not a sentiment. It's not a vibe, right? It is a quantified measure built on economic policy-related news coverage, tax and spending uncertainty, regulatory ambiguity, and geopolitical spillover. When this index rises, it tells us something extremely specific. Decision makers cannot confidently price in the future. Corporations delay capex, households delay spending, and investors misprice risk. Uncertainty is the raw material of volatility, but it does not ignite immediately. So the historical stress point on this chart are essentially these: the Euro crisis 2011-2012. you can see policy uncertainty spike as sovereign debt contagion spreads across Europe. The VIX react violently because the system was fragile. Right? You see Euro crisis, you see the black line, and then the red line just shoots over the black line during the Euro crisis. That was a Greek situation. Basically Greece couldn't make its payments, and they were going to go bankrupt, and they needed more money, and Europe basically said, no more money. You're all retired, 70 years old, and we're going to increase your taxes, and we're going to cut your benefits, and which is a good thing because now they're in pretty good shape. Well, then you have the U.S.-China trade war, as you call when Trump came in, start fighting with Chinese 2018 to 2019. Policy uncertainty rises sharply. Volatility spikes immediately, but remains capped due to central bank liquidity. And this is basically the one, the little spike. Not as bad as the Euro crisis, but there was a spike there. Okay. And then, of course, but it remained capped, though, due to central bank liquidity. So that's when the central banks got in and said, okay, you know what? Let's flood the market. Take it easy. This is the first warning sign of artificial volatility suppression. You flood the market with liquidity, then you're, with water. So you but it's not normal. It's not natural. Maybe sometime you need to let the pressure, and you didn't. Look at the COVID pandemic in 2020. This is the exception that's basically going to prove the rule. Uncertainty explodes, volatility explodes simultaneously. Why? Because policy shock, economic shutdown, liquidity crisis hit at the same time. They said, wow, we're in trouble. We're in big trouble. Look at that spike. But then section 4, we look at the current regime, the most dangerous one. Look at the right side of the chart. Policy uncertainty is elevated and rising again. But volatility is contained, muted, compressed. This is not because risk disappeared. It's because markets believe that the central bank will intervene, the governments will backstop, and liquidity will arrive on demand. This belief is the foundation of moral hazard. Remember 2008 and too big to fail? Hey, we were in banking. We thought, what's the worst thing that could happen? We're going to get bailed out anyway. Well, you don't want the banks to fail. And that's exactly what happened, right? So markets are not calm. They are anesthetized. They're sleeping artificially. So why price for perfection markets break hard? Well, when markets are priced for perfection, which we are now, every day you're going higher, you're more and more priced to perfection. 3 things are true. 1, valuations assume policy stability. 2, risk premia are compressed. 3, volatility selling dominates repositioning. Why do you think they're going after the Fed right now? They want to make sure. I know they're selling you this is a personal story. No, they want to make sure they got this thing completely under control. You've got to keep giving us liquidity. We cannot afford an iota of uncertainty here. So you got to keep the liquidity going even though it is not natural. So that creates a structural fragility. When the shock finally arrives, policy, geopolitical, fiscal, or monetary, there is no margin for error. Geopolitical. What do you think is going there? Do you understand? If you know what I know, and you're sitting on the other side, and you control everything, you want to make sure that, first of all, we've got the Fed under control. Then you want to make sure you get everybody else under control. Geopolitical. Do not start anything with me and with us, basically. So you want to assert control. Just in case someone decides to get a little out of hand, Russia, China, right? Iran, you're there. Because there's no margin for error. The volatility does not rise gradually, it reprices violently. This is how crashes happen in modern markets. Now, if you join my Patreon channel, I will explain to you what I do to prepare for it. Because the signs are there. The question posed on this chart is the correct one. Could a policy or geopolitical shock finally upset the apple cart? Yes, always, eventually. Not because shocks are unpredictable, but because markets refuse to price them until they are forced to. So, in closing, low volatility is a high uncertainty world is not stability. It's a warning light. When policy risk rises and volatility stays compressed, the eventual move is larger, faster, and more disorderly. The chart is not telling you to panic. It is telling you to stop being complacent. That's the reason why you need to watch out.